Hello, and welcome to InvestTrek, the channel dedicated to helping beginning investors increase their investment knowledge to build wealth and achieve financial freedom. Today, we're going to explore the world of mutual funds. Let's dive right in and get started. So, what exactly is a mutual fund? Well, mutual funds are investment vehicles that pool money from various investors to purchase a diversified portfolio of stocks, bonds, or other securities. Originating in the 18th century in Europe, the first U.S. mutual fund, Massachusetts Investors Trust, was established in 1924. Today, mutual funds are immensely popular, with over 100 million Americans investing in them, and trillions of dollars managed across various funds. Managed by professional portfolio managers, mutual funds aim to achieve specific financial goals, such as capital appreciation or income generation. Investors buy shares, and their returns are based on the fund's performance, allowing for diversification and professional management. Now let's talk about the advantages of mutual funds. Compared to individual securities, mutual funds offer three key advantages. First, diversification. By pooling funds, investors can access a wide range of securities, reducing risk. Second, professional management. Experienced managers handle investments, saving time and effort for investors. Third, accessibility. Low minimum investment requirements make mutual funds accessible to a broader audience. These benefits contribute to mutual funds' popularity among both novice and experienced investors. Later in the video, we will provide 3 helpful financial rules of thumb for estimating the future value of investments. Moving on, let's discuss the different types of mutual funds. There are 8 primary types: equity funds, bond funds, balanced funds, money market funds, specialty funds, target date funds, international and global funds, and fund of funds. Let's dive a little deeper into each of them. Equity funds. These funds primarily invest in stocks and are categorized into a few different types. First, we have growth funds, which focus on stocks expected to grow rapidly. Then there are value funds, which invest in undervalued stocks poised for appreciation. Next, we have sector funds that concentrate on specific sectors like technology or healthcare. And finally, index funds aim to replicate the performance of specific market indices, like the S&P 500. Bond funds. These invest in fixed income securities such as government and corporate bonds. They can vary by credit quality and duration, offering different levels of risk and return. Check out our video on stocks and bonds where we dive more deeply into those securities. Balanced or hybrid funds invest in a mix of stocks and bonds to balance growth and income. This mix provides a diversified portfolio, aiming to achieve a moderate risk level with potential for both capital appreciation and income generation. Money market funds. These are low-risk funds that invest in short-term, high-quality investments like treasury bills. They prioritize liquidity and capital preservation. Specialty funds. These focus on specific investment themes, such as real estate investment trusts, commodities, or socially responsible investing. We will cover REITs in more detail in a future video. Please feel free to suggest additional topics you would like us to cover in the comments section. Target date funds. Designed for retirement planning, these funds automatically adjust asset allocation based on a target retirement date, becoming more conservative over time. International and global funds. International funds primarily invest outside the investor's country, while global funds invest worldwide, including in the investor's country. And finally, fund of funds. These funds invest in other mutual funds, offering diversification but often at a higher fee. Understanding costs and fees. Mutual funds come with various costs that can impact returns. Here are some of the costs and fees to be aware of. Expense ratios. This annual fee is a percentage of the fund's average net assets, covering operating expenses and management fees. These typically fall within 0.25 and 1% of your investment amount in the fund per year. Management fees. These fees are paid to fund managers for their expertise and are included in the expense ratio. Sales loads. These are commissions charged when buying or selling shares. They can be either front-end loads, which are charged at purchase, or back-end loads, which are charged upon selling, often decreasing over time. No-load funds. Do not charge sales loads, making them more cost-effective, but they may still have management fees. Additional fees may include 12b1 fees for marketing, redemption fees for selling shares early, and transaction fees for buying or selling within the fund. Importance of comparing fees. Understanding and comparing fees helps investors make informed decisions. So, how do mutual funds pay investors? Well, mutual funds distribute returns primarily through dividends and capital gains. Let's break it down. Dividends. Funds receive income from securities, which is distributed to investors quarterly or annually. Investors can choose to take these in cash or reinvest them. Capital gains. When fund managers sell securities for a profit, these gains are distributed at the fiscal year end. Just like dividends, capital gains can also be reinvested. Net asset value, or NAV, reflects the investment's value, fluctuating with the performance of underlying assets. While it's not a cash payment, it does indicate investment growth. Now let's talk about how to buy mutual funds. Investors can purchase shares directly from fund companies or through brokers at the fund's NAV. Here's how. First, determine your investment goals. Identify your financial goals, risk tolerance, and investment horizon. Next, research funds. Use financial websites or tools to compare funds based on performance, fees, and management reputation. Then, choose a fund. Select one that aligns with your goals and investment strategy. After that, open an investment account. Choose between a brokerage, mutual fund company, or financial advisor. Complete the application by providing the necessary personal and financial details. Fund your account. Transfer money into your account via bank transfer or check. Finally, place your order. Specify the amount to invest or the number of shares to buy. And don't forget to review the confirmation. Keep transaction confirmations for your records. Alright, once you've invested, monitoring and managing your mutual fund investment is crucial. Investors can track mutual fund performance using several methods. First, you can check the fund company website for performance reports, historical data, and key metrics. You can also use financial news websites. Platforms like Morningstar offer performance data and ratings. Investment platforms like online brokerages provide real-time tracking tools. Mobile apps are another great option. Financial apps allow for investment tracking and alerts. Regular statements from your brokerage or fund company will also send performance summaries. Set benchmarks to compare fund performance against relevant market indices. Track key performance metrics. Some important ones include total return. This measures the fund's overall return over a specific period of time, including price appreciation and income. Alpha. This measures the fund's performance relative to a benchmark, indicating active management success. A positive alpha suggests outperformance. Beta. This measures the fund's volatility compared to the market. A beta greater than 1 indicates higher volatility, while a beta less than 1 indicates lower volatility. This helps assess risk. Standard deviation. This measures the fund's price fluctuations over a specific period. A higher standard deviation indicates greater volatility, while a lower standard deviation indicates more stability. Sharpe ratio. This measures risk-adjusted returns. A higher ratio indicates better risk-adjusted performance. Yield. This measures the income generated as a percentage of NAV. Yield can vary widely based on the type of fund and the market. Equity funds might yield 6 to 10% a year on average over 5 years, while bond funds might yield around 3 to 5%. Money market funds tend to have lower yields, often around 1 to 2%. Distribution history. Tracking the fund's history of dividend and capital gains distributions can give insights into its income-generating capability. Turnover ratio measures the frequency of trades within the fund. A high turnover ratio may indicate an actively managed fund, which can lead to higher transaction costs and tax implications. As a bonus for those who stuck it out until this point, here are some simple rules for estimating investment growth and its erosion. The rule of 72 is used to estimate the number of years needed to double an investment at a fixed annual rate of return. You divide 72 by the annual interest rate expressed as a percentage to get the number of years. For example, if your investment earns a 10% annual return, it will take approximately 7 years for it to double in value. The rule of 114 is used to estimate the number of years needed to triple an investment at a fixed annual rate of return. To use the rule of 114, you divide 114 by the annual interest rate expressed as a percentage. For example, If your investment earns a 3% annual return, it will take approximately 38 years to triple the investment. Conversely, the rule of 70 can be used to estimate how long it will take your wealth to lose half its value due to inflation. You divide 70 by the annual inflation rate expressed as a percentage. For example, if annual inflation is running at 3%, you divide 70 by 3 to get approximately 23 years. This illustrates the need to achieve investment returns that outpace inflation to not only preserve, but to also grow your wealth. Tax considerations. As with all investments, taxes must be accounted for. As Benjamin Franklin once said, in this world, nothing can be said to be certain, except death and taxes. Mutual funds are taxed based on the type of income they generate and the investor's tax situation. Distributed dividends are taxed as ordinary income, while qualified dividends may receive a lower capital gains tax rate. Capital gains. Short-term capital gains from assets held less than a year are taxed as ordinary income, while long-term capital gains from assets held over a year are taxed at a lower rate. Net asset value, or NAV investors, incur taxes on NAV increases only when they sell their shares, potentially triggering capital gains taxes on profits. Tax-advantaged accounts. Funds held in accounts like IRAs or 401ks defer taxes on income and gains until withdrawal. It's best to seek the advice of a tax professional to determine the best strategy for managing taxes. Conclusion. To summarize what we covered about mutual fund investing, here are the key considerations. Investment goals. Define your financial objectives. Risk tolerance. Assess your comfort level with risk. Fund types. Choose the right type based on your needs. Expense ratios. Aim for low costs. Performance history. Evaluate past performance. Manager experience. Research the fund manager's track record. Investment horizon. Match funds to your time frame. Tax implications. Understand potential tax effects. Minimum investment. Ensure the fund's minimum fits your budget. Diversification. Confirm sufficient diversification in your fund. Additional resources. For further information on mutual funds, please see the links in the description below. Future content will cover ETFs, REITs, and other types of investments to assist you on your investment journey. Please like and subscribe to this channel to help us provide information on additional investment topics. Happy investing!